Let's face it, cyber attackers have the advantage. ExtraHop is on a mission to help you take it back. Regain the upper hand with security that can't be undermined, outsmarted, or compromised. When you don't have to choose between protecting your business and moving it forward, that's security uncompromised. See how it works in the full product demo, free online at securityweekly.com/extrahop. SOC analysts are often overworked and underappreciated. In fact, 78% say that working in the SOC is very painful. Yikes. On October 20th, Devo is establishing SOC Analyst Appreciation Day to pay some long overdue kudos to you and encourage organizations to improve SOC analyst job satisfaction and mental well-being. Join Devo as they celebrate SOC analysts around the world and provide opportunities for personal and professional development, all while you unwind with programming specifically designed to help you de-stress. You can also win a Nintendo Switch if you participate in Devo's Twitter hashtag contest. All you have to do is follow at Devo_Inc. on Twitter and tweet using hashtag SOC Analyst Day. Visit securityweekly.com/Devo to sign up and learn more. Did you know that 81% of data breaches are caused by weak password security? Keeper Security's easy-to-use password manager platform keeps your passwords safe, easy to share, and out of reach of cybercriminals. Keeper is the leading cybersecurity platform for preventing password-related data breaches and cyber threats. Check out Keeper and get a free 3-year Keeper password manager solution when you take a demo of Keeper for Business. Learn more at securityweekly.com/Keeper Security.
Welcome back to Enterprise Security Weekly. Joining me for this interview is Mr. Paul Asadorian. Hello, Paul.
Hey, Adrian. How's it going? Good to be here.
Yeah, going good. Yeah, so we're pre-recording this, and it's always interesting doing one of these. Unfortunately, Paul will not be with us for the rest of the show, but I am glad you are here for this one. This is going to be a fun one.
Yeah, it's kind of weird doing shows remotely, but I apologize for my background. It's a little messy.
All right, few announcements. Don't miss any of your favorite Security Weekly content. Visit securityweekly.com/subscribe to subscribe to any of our podcast feeds and have all new episodes downloaded right to your phone. You can also join our mailing list, our Discord server, and follow us on social media and our streaming platforms. Security Weekly Unlocked will be held in person this December 5th through 7th at the Hilton Lake Buena Vista. Keynotes from Alyssa Miller, John Strand, Leslie Carhart, and Dave Kennedy. Visit securityweekly.com/unlocked to register and check out our rockstar lineup. And for our final interview today, we're talking to Will Lin, Managing Director and Co-founder at Forgepoint Capital, a VC firm that focuses exclusively on cybersecurity companies. Will is also co-founder and president of the Security Tinkerers, a nonprofit organization that brings together InfoSec professionals to share, mentor, and create opportunities in the community for older folks such as myself, veterans in the field, and newcomers as well. It's a place I spent a lot of time and really a labor of love. I think we all get a lot out of it, and it's really, really kind of precious to us. He's also a regular contributor to Security Week, is very knowledgeable, well-connected, and very generous with his time, like coming on the show to talk to us today. Welcome to the show, Will.
Thank you, Adrian. Really, really kind introduction. Appreciate it.
Yeah, so starting off, first off, how did you find your way to cybersecurity?
I fell into it. I think and this story gets more common now in security. You tinker as a young kid, love playing with toys and electronics, and then eventually you fall into computers and cybersecurity. I think for me, it really came from more the building and selling computers dynamic, having to deal with viruses early on, and then just sort of following that trend from then on.
Yeah. Falling into it is something we hear often when we ask people how they got into security.
No kidding.
Yeah. So, I mentioned Forgepoint focuses exclusively on the cybersecurity market. What were the reasons behind doing that? I guess more from an investor perspective, because there aren't a ton of VC firms that are exclusive to cybersecurity startups.
Yeah. I mean, And this is something I've started saying recently versus when we started. So I can't take credit for having this wisdom or these lessons learned when we started. Recently, I think the realization has been that in order to progress, in order to grow in today's industry or in today's environment, specialization is so important. You really, really have to specialize in something to progress upwards. And then eventually, if you're lucky, you get the luxury of being a generalist where you can do more than just one thing. And so following along that path, that's essentially what we did. We created a new venture capital firm from scratch. And we realized very quickly specialization would help us a lot in terms of helping us get to becoming one of the most active, one of the most well-known, and so that we can aspire to be like one of the storied venture capital firms that are 50, 60, 70 years old, that kind of thing. And so we are 6 years old now. We specialized in security back then, and we're fortunate to be one of the most active investors, have the largest teams, have the largest portfolio in cybersecurity startups today because of that specialization. But the true reason is the founding team. 3 of us came from Trident Capital. We all had a deep passion for security. A lot of our successes came from cybersecurity as well. And so we decided to experiment and see what would happen if we decided to create a security-only fund. And it's led to a lot of success on our end, luckily.
I imagine, does it make it easier to raise the fund as well? Are most people kind of, generally, the same frame of mind that cybersecurity is pretty big, a good place to put their money?
This is one where it actually, in some ways, felt harder, right? Because when folks invest, including ourselves, we invest based off of our experience that's formulated into patterns. And based on those patterns, it allows us to make fast decisions and wise and thoughtful decisions going forward as well. And the issue is that there was no pattern for a cybersecurity focused fund when we fundraised initially back in 2015, 16. And so I would say it was actually harder. The other reality, though, is when you start a firm from scratch, it's always hard. And especially back then, we'd just come from a huge recession. And a lot of venture capital firms were actually going under versus being created. And so it was also a very difficult environment. So it's hard for me to tell how much of it was because of the environment that we started in and how much of it was because of the focus in security. But we definitely got a lot of no's saying, hey, security is a niche. It's too small for a security-focused fund. And so taking that feedback back, I would say that it did feel harder.
I bet those same people aren't saying that now, though.
They are not saying that now. They're not saying that now. That's right.
So speaking of these investments, for folks that know VC firms, not only just focusing on cybersecurity, you generally choose, what part of the path you're going to focus on, right? If you're going to be early stage, late stage, somewhere in between. Do you want to talk about that real quick?
Yeah. This is one thing that, and I'm actually writing a book on venture capital just because I've been in venture my whole career. My spouse is also in venture capital, and then a lot of my friends are in venture capital or in security or entrepreneurs. And so I feel like I've been able to learn from and experience a lot of journeys within venture. And when I initially started, and this is empathy for the audience, I didn't understand why there was seed stage, early stage, late stage, growth stage, IPO. Like there was just so much variety in terms of investing. And I didn't know why one person wanted to do only one type of investing. And this actually goes back to that specialization point from before. Whenever there is a bucket of similar opportunities, there is value in specializing and learning all there is to learn about that bucket of opportunities. And that's basically what's happening within the venture capital space. The companies that are raising seed capital, they need a different investor than the companies raising their early stage capital. And then the companies raising late stage, they all need something slightly different. The earlier they are, the more that they are asking, wanting involvement, active involvement from their investor. And the later stage they tend to be like all guns blazing, right? They have hundreds of people on their teams, and it's all about scale, scale, scale. And so they're at that point, they're usually looking for VCs to be less active, because the other dynamic then is they've already worked with 3, 4, 5 VCs that are on their board and adding value. Adding one more cook to the kitchen seems like a lot in the later stages as well. And so as a result, you need a slightly different value add. You need a slightly different way of thinking about things. And then lastly, we can talk about like sort of public companies, right? Those folks, they have much less involvement, / no involvement in the companies. And so you need to think differently when you're a hedge fund investor, for example, as well.
And from my perspective, having been an entrepreneur, I would think that a VC, an investor that specialized more, just focus on security, just focused at a single stage, would be a better partner to have, because all their experience would be, specialized in that one area. You would have a really good idea of what a company needs at that point in their growth.
Completely. And in some ways, I have to defer to the wisdom of my co-founders or just luck, and however we want to categorize it. But we decided to specialize in early stage really early on, because for us, the security focus was a huge sort of specialization and sort of a strength, but we want to interpret as a strength. And where it's interpreted as a strength is in the early stages, right? When they really want someone to be hands-on, to work with them side by side as well. If we were a specialist security fund only doing like hedge fund, it'd be good. It'd be a really knowledge-centric type value add versus a hands-on company building value add as well. And because we also really wanted to be hands-on company builders, it just made it very obvious and natural for us to be early stage investors. And so that was our strength, right? And in some ways, you want to find people who like you for your strengths, who appreciate what's the value add that you can provide. And so it's a win-win on both sides. And so we're happy to provide the value, and the folks want the value. And that tends to be in the early stages. The reality is that seed stage companies, they want the most value of anyone else, right? Because they're like 3 people, 10 people,
right?
And they have the least amount of resources that because they don't have the people or the funding to be able to have all the resources they need under the sun. But the issue is that seed stage investing is so different than early stage investing, where it's more the phrase is spray and pray, right? And we just really didn't want to invest in like 100 seed stage companies in security, and then for 80 of them to fail, for example. That would just really hurt our soul because of the whole company building dynamic that we wanted to do. And so in the end, it ended up being sort of perfect to focus on the early stages. So these are like 10 to 50 people type companies.
So, Will, when you are a company and you've moved beyond the seed stage,
Right.
how do you advise your clients? I guess I look at 2 different areas, right? Growth in sales and marketing, and growth in R&D to diversify the product set. I guess I'm more interested in how you advise your investments on diversifying the product set while still maintaining their focus and point of view in the problem they solve in the market.
Yeah, I mean, it is. This is a unending question, I would say, because, and this actually for me, when this types of question forces me to put on my product management hat. And so, what I will say for this question is it's sort of like different depending on the situation, right? Like if you have a clear incumbent, everyone loves them, right? It's going to be really difficult to go head to head against that clear incumbent that it's universally loved. And so you have to think about how you market yourself, sell yourself, message, position yourself differently than in a market where there might not be a leader, or the leader is sort of on their way down in terms of credibility and confidence. And so you have to think a little bit differently that way as well. I would say the most difficult one, I think, is when you have to create a new market. A lot of initial excitement, because people are like, oh, they love learning about these new ideas, especially if it's a new idea that's compelling and interesting. But then it's such an emotional roller coaster, right? Like everyone loves learning a lot about it. They love talking to each other about it. And then in security, cynicism is high.
Yeah.
And so the cynicism adds on, and it's like, boom, no one wants to talk about it anymore. And so like you have to sort of balance that dynamic as well.
Yeah, it's interesting. It sounds like it's almost always a combination of sales and marketing and R&D, right? Especially in a new market. You really have to drive home, your go-to-market strategy if you're in or creating a new market. That's where I've seen a lot of companies struggle.
The holy grail is when all three of them work together perfectly. Mm-hmm. And when that does, and you're in the right market as well, that's when you have a public company, like just unicorn, whatever sort of metric you want to use in terms of success. That's when it happens. And so but the reality is that there are times when companies are really successful because of only one thing, really good sales, really good marketing, and then maybe subpar engineering. The only time where things don't work out is when you have phenomenal engineering, but really subpar sales and marketing, right? Because you have a great tech, but no one's buying it. So you're not generating revenue. You're not hiring people. You're not growing.
Mm.
Yeah, I think we've definitely seen some cases, the flip side of that. It's kind of amazing how far a company can go that aren't great on the engineering side. Don't have a great product, but just amazing sales and marketing can take you so far. And it's kind of interesting to see what happens there, because sometimes it's by design. It's like, we'll fix that, down the road, or we'll make improvements down the road. And if that doesn't happen,
technical debt is real.
Yeah. So and some of those companies, like once you get to a certain size, it seems like it's much more difficult to correct some of those shortcomings.
Completely. And it shows up in the technology. It shows up in the engineering, to the point of technical debt, architecture, all that. But it also shows up in the financials, right? Because the companies that didn't build a solution that scales will have lower gross margins, and they will be less profitable as well. And so everything shows up. It's sort of like an ecosystem. They all like work so well together, and you can find these signals in each of the factors to figure out, okay, this is how well engineering is doing, but just looking at the numbers, or this is how well sales is doing, but just looking at the code, for example. And it's these like small things that you pick up over time, and you sort of start being able to pattern match off of them.
Yeah, do you look at customer churn a lot? Because that's one where I think that hits some security companies pretty hard, because oftentimes people don't fully understand what they're buying into when they buy it, and once they start using the product, they become more educated, because a lot of security categories are brand new categories.
Right. Yeah. Yes. Yeah. I mean, I think the interesting thing about churn is that when it's the new category, I do feel like people stay on longer than expected. Right? Even if they are not getting the full value, sometimes when they could just end it after a year, they end it after 2 years or 3 years. Because I think some of it has to do with the promise of a new category and the roadmap saying, okay, well, I'm going to work on this, I'm going to solve this, I'm going to do that. And just like, okay, I'm going to wait 1 more year. Okay, I'm going to wait one more year. And there's also the push, right? So for instance, if the push was incredibly difficult to get the vendor in, it would be really painful and make that person look bad if after a year they canceled it, said, hey, I made this huge push to buy this thing and it sucks. Made a horrible decision and it sucks, right? And so there is that incentivization as well to keep going and say, okay, let's turn another page, see how it goes. Let's turn another page and see how it goes. Because of just all these human dynamics that, we're all we all have to empathize with and have gone through in our past as well.
Without getting too much into any proprietary investment strategies, can you explain to us a little bit about how you choose a company to invest in? How much of that is, we need somebody in this market that's really hot right now versus more just looking for the right founders, the right talent? I'm sure it's a mix of things, but
it's definitely a mix. I mean, I think the beautiful thing about, and this goes to the diversity point that we've all heard before, right? There's power and value in diversity. Everyone has a different lens. Like they have different filters. They have different reasons of why they're excited about one thing and they're not excited about the other. And it's like a combination of all their experience, it's a combination of all their mentorship as well. And so the high level point is it is different for everyone. But there are some core ingredients that I think everyone does use. Everyone does look at the team. Some people value it as the most important factor. Some people value it as third, fourth, fifth, whatever it might be. Everyone wants to spend time thinking about the size of the market, especially in venture when your big winners really drive your returns. You want to make sure that the bigger the market, the better. But the difference is that some folks will believe like, hey, this is a market that is tiny now or non-existent now, but could become a huge market. While some folks like, hey, I'm only going to invest in a market that's already huge, but they're going to displace the incumbent, for example. And so there's different techniques or dynamics in terms of how you think about the market. I think everyone spends time thinking about how the go-to-market motion, because that is and as we mentioned before, right? Let's say the two factors, sales, marketing, and then engineering. The one that really has more of a short term and long term, more measurable impact is the sales and marketing side. So some folks spend a lot of time thinking about, okay, what's the sales cycle? What's the average selling price? How much budget are you getting per year? They're looking at conversion rates. It's like, okay, every time you compete against this company, you win 80% of the time, 100% of the time. Who's your direct competitor? So spending time thinking about, hey, if I was a salesperson in your company, what should I expect? How hard is it going to sell? Is it going to be to sell this thing? How easily will it be for me to hit my quota? That kind of dynamics types of questions. And there's probably two more that I'm writing down in my book, but there's I would say that in the end, there's about 6 factors: team, product, market, go-to-market motion, timing. And then this one's a little bit fluffier, but I think it's so important, is product management or customer empathy. Their ability to pivot when the time needs them to pivot.
Yeah, I think that's huge. It's been my theory that it's harder for a security company to survive long term as a public company because of that need to pivot in the market. Because sometimes a category is good, it's needed, it brings value, but then the cloud happens, and you kind of have to pivot. As technology changes. Security kind of has to follow because it exists on top of other things, to secure other things. And when those things shift, and I think maybe it's a bit tougher as a public company, to easily pivot than maybe a private company. So I don't know if this is common in other markets, but we see a lot of take privates. They kind of reinvent themselves, mush them together with some other startups and, reinvent them, maybe take them public again.
Completely. Yeah. It's, for me, I love watching, I don't want to assume that every company that goes public or does really well eventually will fail, right? Because that's not true.
Right.
There are companies that they're able to persist for long term. And why are they able to do it? It's because they're the pivots, exactly to your point. Or the new markets that they grow into, right? Like I think one that everyone understands is the whole Netflix pivot to cloud, right? Or to streaming. I remember when they made that pivot, it didn't feel like it made sense. It wasn't obvious then.
Yeah.
but they made the pivot and they did it hard, and it's turned them to the amazing business that they are today. And there's so many examples like that.
So, fun fact, I don't know if you remember, but Hollywood Video and Blockbuster were not allowed to merge because of antitrust concerns, which seems ridiculous now, but at the time.
Right. Completely.
Yeah.
I guess my question along those lines, when I think about creating a new startup and folks creating new startups, is how do you differentiate a feature from a product, and how does that evolve over time? Because I see, larger public companies adding new features that are also like a whole category of startups. So how do you compete in from both, sides of that coin?
Yeah. I think this one really comes down to the customer, because taking a quick step back, from every entrepreneur's perspective, they want to be a platform, right? They want to have a full suite of solutions. They want to solve multiple problems. They want to be enduring. They want to be one day a public company, or almost all of them want this. Not every single one, but a decent chunk do, and it's a good enough pattern to assume most of the time. But why do they only market a feature versus a platform? Sometimes it is maybe they're just not aware that the problem that they think is a platform is actually a pretty small solution. That happens. I wouldn't say that's impossible, but I would say the biggest one has to do with what the customers are comfortable with, right? Because when you're a tiny little company and you're saying, I'm going to solve the world, the customers say, I don't believe you, and stop wasting my time, right? What can you actually reasonably solve for me today, or in a very, very short term? Because if not, I'm going to move on, because there are thousands of other companies to spend time to talk to as well. But there are some cases, and whether it's the team, whether it's the vision, whether it's the open space in the problem because no one else is touching anything, sometimes a company can pitch a huge platform solution and get away with it. Not in a bad way, in a, hey, people believe it, understand it, and are open to it as well. And so that's what I feel like is the bar, right? Like, if you can't convince a customer that you're a platform, don't try to. Don't waste your time. Focus on what you can solve for them in the short term. And then over time, they will want you to become a platform, right? You're already in there. They want you to grow. They want you to solve more problems. They want you to do more for them. So there is a very natural win-win down the line. The big thing first is just, let's start working together. Let's get something going.
Listen to your customers, right? Once you've got your foot in the door.
Completely. I don't think any customer says, hey, I only want you to do this until the end of time. Please don't bother me forever, right? Unless it's a really boring problem. And it's such a commodity problem and a commodity solution. Sure, fine. But generally, people like the idea of working, of getting more value from their existing solutions. And then if they have to pay more, they'll, and the ROI is clear and obvious, fine. It's a win-win. I'm comfortable with it. But and so there is a very natural way of partnering well with your customers, and you just have to just keep crushing it. Just keep doing well.
It's a long road too.
Completely.
Yeah. So I was just going to jump ahead and pivot a bit, since you mentioned companies getting away with really big platforms. On some of the key transactions I wanted to talk about today, and we're not going to get to all of them, but there are a couple that kind of fit that mold, I feel like. And so there's SNCC, raised a Series F, $605 million at an $8.5 billion valuation. I forget how old SNCC is at this point, but I think they're actually the oldest of the three I'm putting in this category. We also have Orca, who is I think they're barely 2 years old, and they raised a 550 million Series C extension on top of a 210 million Series C, valued at 1.8 billion. And then Wiz, who seems like they're directly competing with Orca in a lot of places, $250 million Series C. They're 18 months old, or at least they were when they announced that in October. Earlier this month in October, and $6 billion valuation, 18 months old.
Yeah. How far back or how high level, how economics do you want me to talk about? I can talk about sort of why VCs doing what they're doing, why the entrepreneurs are doing what they're doing, what are the different factors that are causing it. Like in the, actually, why don't I just start and then you direct me?
Sure.
Yeah. I think if I were to try to hone down everything, like these three deals, what are people doing? Why are they doing all that stuff? It really all comes down to the amount of capital that needs to be invested in today's world. Low interest rates, people need to beat inflation, and if and best and even better, they need to grow those savings that they do have. And so in today's world, the traditional places to invest have gotten less and less valuable. And so as a result, more and more money is being put into venture capital. And and that venture capital dollars is being used to invest in companies. The trick or the style or the way that people have been primarily evolving in today's world because of all the dollars is with the preemptive round, which is basically saying, hey, everything you're doing, it looks like in 3 years, 2 years, 1 year, you are going to hit exactly what I normally invest in. And so I'm going to invest in you now, 1, 2, 3 years early, because I have confidence that you're going to hit those metrics that I normally invest in. And so I've gone earlier stage. And that's essentially what almost everyone has done, right? So an $8.5 billion valuation, for instance, for Wiz, that's a public company valuation. It's basically saying, hey, I know for a fact that Wiz, Orca, Sneak are going to be public companies or essentially there. And in a certain amount of time, and you have more than enough money to spend to grow. And so that eventually in however much years times, you will be the company that I normally invest in. And eventually you'll become a public company. So there's that dynamic to just sort of see how it's all flowed to where we are today. The other dynamic, which also comes from the low interest rates, is the public market multiples have increased as well. And so in order to be a public company, you actually need less revenue now because the multiples are so high. Before, you had to almost always hit $100 million of revenue in order to be a public company, and you'd be valued at 6, 7, 8, 9, whatever, like some range multiple there. If you're like an exceptional business, and there's 1 out of 20 or something like that, they get like a 12, 13, 14, maybe 20x multiple on revenue. But now 20, 30, 40, 50 is more common. And so you can be a smaller company and be valued the same way that people have been in the past. So that's a second sort of underlying driver that's occurring. And then the third one is not related to interest rates, but related to technology evolving, related to globalization, related to more people doing business on the internet. It is possible to grow your business revenue-wise a lot faster now than it was in the past as well. And so because of that maturity, because of that digital way of doing business, you can also get to that, let's say the $100 million revenue number is the goal. You can also achieve the $100 million revenue faster in today's environment than it was in the past. For me, the way I've noticed sort of the world is, people like leaders. They really love leaders, right? Because, you associate a lot of great things to a leader. You associate that they will be the leader for a long time as well. And so their roadmap is going to be better than their peers. You associate that they are going to hire and get the best people because they're the leader in their space. You associate that they're going to grow the fastest. I mean, it's an amazing position to be a leader. And so as a result of that, that's why the leaders are growing so fast, because the customers are thinking the same way as well, where they're like, okay, I have a problem. I have budget. I think the best place for me to put it is with the leader of that space, of this problem, that's solving this problem. And so, and that's how the VCs are thinking about it as well. Should we break that bias, that leadership bias? I don't know. I'm still trying to form an opinion on it, but there is that bias in humanity where we really, really, really love leaders.
And I guess the thing giving me whiplash is that, less than 10 years ago, security companies would IPO, and get maybe 100 million out of it, 200 million out of it, and the growth, like a lot of growth would be anything over 20% year over year. Now we've got SentinelOne, I think, raised over 1.2 billion with their IPO, and the stock, like CrowdStrike, has just gone up from there. And now we're seeing some of these faster growing companies raising every 7 months instead of every 18 months, which used to be normal. And I got to think like the sales cycle has to be fairly short, and like you need to go off of new metrics like year over year growth rate. Like, forget that, we're talking month over month growth rate, aren't we, or something like that?
Yeah, I love this question because it's sort of a question that's like, when you're not so the preemptive thing is just amazing. It's just so amazing to watch. I just like the what's going on in these companies is that they are raising more and more money despite not spending the previous money that they've had. Right. So historically, the way to do things was you raise, let's say, $20 million and you spend that $20 million in 18 months to 2 years to the point that you made. And so you could actually have a decent guess of how much money they were burning because of when they were raising. And then you would hope that if they're burning that much money, they're also growing. And then what you can do is you can do an efficiency, right? Like, okay, they burned $20 million, but they added 40. Holy crap, super efficient. That's like, we need to invest more money into this business because it's like a money machine, right? You put in $1, you get $2, right? It's like, why not put more money in that machine?
Right.
So that's what it used to be, and that's still happening. But these like landmark cases, right, or these like newsworthy things, are situations where almost everything's preemptive. It's a different way of measuring it now. It's like, how many times can they get a preemptive round before they really need to demonstrate growth and demonstrate the numbers, right? So going to that, the way I described preemptive just now, you invest in the company and you're like, hey, I believe that in 1, 2, 3 years, you're going to be the company that I normally invest in. And so even though you have, let's say, 30 million of cash on the balance sheet now, and you're going to spend that $30 million over the next 2 to 3 years, I'm just going to give you credit for those 2 to 3 years of growth. Assume that you spend out all that $30 million, and I'm going to give you another 50, 100, something like that. And so now you're capitalized not only for the next 3 years, you're capitalized for the next 6, 7, 8, 9 years, that kind of thing. And so in the meantime, I'm just going to hang out. I'm going to add value for 9 years instead of adding value for, let's say, 6 years, something like that, making numbers or making time. And so that's what's going on, right? Like they aren't spending this money like crazy. So for instance, like the Orca number, right? They raised 200 something, and then the 500 something. They didn't spend all that 200. Like there's no way, they spent anywhere close to all that money before they raised this $500 million round. It's basically they're just capitalizing the business. Now the company has so much money. It's pretty much the next round is IPO. And this actually brings me to talk about another factor that's driving all this stuff, but we don't have to go back to that one. But there is that's sort of what's going on. It's this feeling of I already have a lot of money. If you want to give me more, you have to give it to me at assuming that I've generated a whole bunch of success.
Yeah. Well, man, we're going to have to do this again, Will, because I've got so many other questions. This has all been amazing stuff. I've already learned a ton in just 30, 40 minutes here. But yeah, thank you so much for joining us on Enterprise Security Weekly today.
Thanks, Will.
I was delighted. Thank you.
And thank you, Paul, for joining me today. And a big thanks to everyone for watching or listening to this week's episode of Enterprise Security Weekly. We'll see you next week.